Hey everybody, happy Monday. Welcome back to the Gamma Report, 2 p.m. Eastern Time, Monday the 17th. Let me go ahead and grab the screen here and let's get after it. So, little showcase for the day. Markets are off to a sluggish start. Um, Nothing terribly damaging, I don't think. Had a lot to talk about today, actually, as we approach kind of our last week before we have holiday disruptions. Next week is Thanksgiving, Thursday, Friday, limited trading hours. Friday, the market's open, I think, until 1 p.m. But it's going to be likely going into whatever the holiday market looks like for Thanksgiving. Thanksgiving floating all the way to New Year's. Marks just kind of exist. Typically, I look at that as like path of least resistance. There's oftentimes just some drift. Whatever's kind of set in motion stays in motion. So we will see if there's the ability for maybe Nvidia this week with earnings to come in and push the market higher. That's going to be a big kind of key catalyst this week. Would be Nvidia. Since recent sell-off, number one company in the world, $4.5 trillion, back down to recent lows. Pretty well supported. It certainly looks a lot like the S&P 500 and the NASDAQ, where we're using this 21 and 50-day moving average as support. So I actually want to price out some video earnings, kind of give us some expectations of where things could be going. A lot of times earnings history shows us that it's all kind of baked in and priced in. There's not a lot of typical movement during earnings. It's usually something that's best to be like a premium seller. But I think it also sets the tone with how the market's going to finish off the rest of the year. Okay. So let's price out a couple of things. Nice to be with every as always for Gamma Report. Blake, will you let me know in the chat? Am I flying solo today? Does Kane have another webinar? Either way, all good. We're streaming this on YouTube. It's youtube.com/financial wars. We're live. We're recording this. If you're, in my Telegram, or this session is every Monday now. So I'm happy to kind of have this roll into my final hour. We have some trades running from daily profit play this morning. As long as price stays above this blue line around 66.20 or below this one at 67.80, we will see. It's like market opened up at 09 all the way down to 20. It's like we'd have to have like a pretty terrible Monday. So I'm just contemplating, like, do I need a defense trade down here? Probably not. It's late enough in the day. I don't think I need one. But let me see if it's cheap enough that maybe it would be still give me a net winner on the day and I can play some pretty sick defense. I don't think I need it though. ADR is already, kind of overstretched. 70 points on the day. We've gone from a high of around 67.55. So high at 67.55. ADR is around 70 points. We have gone 80 points on the day. Here's a high at 67.55. We're currently at a low at 73. That's over 100 points on the day. So we're, 100+% extended from like an ADR calculation. Previous lows from Friday last week, that's at 66.50. My line in the sand for my daily profit play is 66.20. That's my sell put from this morning. So we should be in pretty good shape. I suppose, VIX is at 2141. Let me do some rough calculations here. So we had let me go from the close. So open, calculate out, VIX is around 2239. 2239. So 1.4%. I don't think we necessarily get there today, but just to be on the safe side, 1.4, maybe around 15. This will be a pending order. Well, I've already got the 20 and 15. I should be safe on this trade. 10. So if I buy, sell, skip, try this bad boy for either 50 cents or $1, I'll try that trade. I don't think I'm going to need that trade. It's going to be a pending order. Okay, I'm going to throw this in my daily profit play just in case. Okay, DPP looking good for full profit today with the put side line in the sand at 66.20, just in case. I'm putting in a pending order at the lows with a broken wing butterfly. Pending, not filled, and it's below our put spread. So I'll put that trade in right now for daily profit play. That is a 66.10, 66.05, and skip to the 65.95. 50 cents to $1 credit. Pending order. This is unlikely to fill, and most likely our DPP will finish with full $1 credit today. Okay, so the trade doesn't cost us anything. It's a pending order for credit. I don't think I'm going to fill it on the trade unless price is going to continue to slide. Even my gamma levels that I have on the day today, even to the low side, we have a 100% HER, and the lowest gamma is around 66.50. So I don't think we're going to 20, which is my put side. I don't think we're going to 10, which is my butterfly pin to get filled. More than likely, I think we'll probably just kind of, I don't know, hang out here for the day. Maybe we hit here, go back to center, maybe around 6,700 and hang out. So I'll watch this as the day continues. Okay. 60 and MMM was not here. What's that mean, Sean? 60 and MMM was not here. I saw 45 this morning. When we did daily profit play, my plus minus was 45 in the day. So, I mean, we were like 70, 75 points clear of that to start out the day with our daily profit play. So, like I said, I think we're still going to be fine. Let me look. My put side is trading for a six delta, which means we still have about a 94% chance this trade is profitable. I mean, I'll take those odds going into the day, especially if I don't have any gamma that lights up to the downside to even threaten that. So, I think we're going to be totally fine. So, I'd say again, that's why I put it in as a pending order, because it's a credit spread, which means if I get filled, I get the credit. I've got a bonus trap of $500. It's a nice little defense trade based on me calculating out my DPP, which is daily profit play, my highs and lows based on the VIX. All these things we calculate out. I do want to let everyone know here, if I have some traders that are in my daily profit play sessions, you're familiar with this talk and this prep. This week on Daily Profit Play, I am hosting a masterclass on Tuesday and Wednesday. I'm doing back-to-back masterclasses, and the goal is let's put together this entire game plan like we do every single day. And what I've become better and better at day to day after doing this stuff for 3 years and refining this, and I like what we're doing. I mean, we've got a win streak of like 32 out of 35 trades this last little stretch. 32 out of 35 is pretty good. We're still winning 91% of our trades. We're also, what I'm teaching this week is how to talk about the risk management side and also have a defense trade. Basically, my favorite combination is to put in the trade as is, like the core strategy, and then put in a couple of pending orders as high probability tops and defense levels. Okay, I took a trade today that my defense level was, I took this trade for $1. I put a defense trade up here. That was a 50-cent risk. So if I lose this trade, I still make $1 on the day. I make profit today. So I make 50 cents a contract. Okay. My favorite way, what I'll teach this week, is if I take the core strategy and I put in a defense trade and another defense trade, we don't need these trades unless we need them, right? Like they're there. So I don't have to take the trade for risk necessarily unless they're filled. And then we acknowledge the risk. And it's kind of like, okay, having a backup plan. And that also helps us. Like this happened last week on Thursday. I had a backup plan on Thursday where for daily profit play, Thursday was a pretty crazy day, as was Friday. The backup plan was I had a daily profit play trade in for the day, and then I had a defense trade at the bottom. I ended up making that trade, I think for the end of the day, closed out about 300 and I want to say like $350 profit at the end of the day. I closed it out for a managed win of about, I'm trying to think, I did like a one. I closed it out for like a 190. I think I made like $150. And and I had a butterfly. I don't remember. I remember winning the day. Like whatever it was on Thursday, I know that I won the day. It wasn't fun. We still survived. We still made a few bucks. I think I ended up netting about $100 for the day, and I could have made about $300 for the day if I let things go all the way to expiration. But I managed the broken wing butterfly, and it worked out fine. And then Friday we kind of did the same thing. We played some defense. End of the day settled, grabbed a few $100. Ended up making about $150 profit on Friday, and ended up having like we had a full winner on our daily profit play. We lost on a hedge and won on a separate hedge. And net was I saw traders anywhere between 10 cents on the day profit. So we won the day, even though it's a small win, but certainly in zero DT, like managing risk is so important. Or I had traders that were emailing me, after Friday's session saying, Chris, that was great. Made $250 today, made $350 today. It paid up to a couple $100. So either way, it's like, this is, if you like the idea, okay, if you like the idea of, you don't have to think big picture here. And that's it's kind of refreshing, because obviously as a long-term investor, you buy every dip and the market goes up, and give yourself 5, 10, 15, 20 years in the market and you'll be fine. That's the easiest thing ever. It's not going to be always guaranteed. We're going to have up years of 10, 20%. We're going to have down years of 20, 30%. Drawdowns are always a part of trading. But in the long run, it's designed to go higher. It's positive drift. It's force flows. As long as 401ks participate, as long as this like zombie buy market, and every month it's government 401ks, force buying in the market, stock buybacks. It's a feeding mechanism that just pushes liquidity into the markets. So until that all changes, it's going to be a positive drift environment. Give yourself 5 or 10 years and you'll be fine. Okay. But day to day, how many traders want this? If your averages, okay, okay, all right, Keith, how about you tone it down, dude? I mean, I'm just trying to help. Like what I'm sharing is stuff on my daily profit play with. This is a paid member service, and I have 200 people a day that come talk to me. So I'm just showcasing what we did this morning and what we did last week. So, I'm not here to talk over anybody. I can literally teach all this stuff. If you're willing to learn, I'll teach you. What I think is silly if you're just like, Chris, just talk about buying calls. Keep it simple. It's like, look, man, I do keep it simple. I didn't know anything about options 10 years ago, and now I trade them almost exclusively. And I think that if anybody is watching the session and you're a one-trick pony, you should have more tools in your toolkit. There's more ways to trade this market. The market's not going to go up forever. We're going to have a period of years where it goes sideways. Okay? Buying, passively investing, that's going to feel like crap when the market doesn't return anything. My job is to go up, down, sideways. I've got to make money. Got to find a way. If we have a 20 to 50% pullback in the markets, I want to still be break even or better, and also position myself for tons of upside potential in the near future. But you can do that bigger picture. You can do that day to day. All I'm showing is day to day, there are ways to approach this market day to day strategically that we can calculate with a high degree of certainty where this top or bottom of the day will be. Okay? Meaning price shouldn't go too much higher than what we calculate. Price shouldn't go too much lower than what we calculate. And if it does, it's not perfect, but for the most part, we have this stuff running in real time and we're not wrong usually. So that's a good thing to know. Like to have that in your sleeve coming into the markets every day, feeling like I've got a pretty good sense where the market's top or bottom is today. If it gets there, I can defend against it. I can usually generate some income from those highs and lows, as well as the standard kind of core strategies that we put into the markets every day. Okay. So what I'm saying is, on a day-to-day basis, some traders like the idea of, I don't want to know what Trump's going to say next. I don't want to know what the Fed's going to do. I don't care what the overall market's going to do. I just want to show up and trade today. And can I make money today? Can I win the day? Some traders like that. Some traders like that approach, and that is like clear thinking. All you're doing is staying in the present moment, trading what is in front of you, win the day, and manage risk. Right? So if that's a tactic, if that's an approach for you, it's very realistic to just trade for the day, win the day, and it adds up. I mean, if the last 34 trades I've taken, we've had 31, 32 winners out of that streak, it's like we're making some pretty good capital. And did I care about the Fed maybe not raising or cutting rates in December? Do I care that Trump tweeted and rattled the markets on October 10th? Do I care about the fact we haven't hit a 50-day moving average in 130 bars? Like, none of that matters. What matters is today, based on some pretty straightforward calculations. Where is price going to go today? And where can I trade it today? Because some people like that idea where you don't have to carry this overnight risk. You don't have to guess where the market's going big picture. You just trade the day. Because one thing that is happening behind the scenes is for the last 50 years, market makers have to do this stuff. And market makers are in the markets for every expiration that we see in the options market. And they are providing liquidity and making the markets efficient. Up or down or sideways, they are making the markets efficient. So we align ourselves with that, style, and then we do some calculations to help us with our tops and bottoms. So if we need to have defense, we can have defense. Okay. Do you do vertical spreads? Yeah. And I don't think anybody here is too simple, too beginner for anything. Okay. That would be like saying that nobody can understand just a bid ask. Nobody can understand buying versus selling. It's like, if you are going to play this game of trading, would you rather keep it so simple that all you do is forever play tic-tac-toe? Or would you upgrade to checkers or upgrade to chess? If you're in this market long enough, you will want to learn more. And you owe it to yourself to learn more. And you're all smart and you're all capable. And there's nothing that I teach that I haven't taught myself. There's nothing that I teach that I haven't done in the markets myself. There's nothing that I teach that I'm not trading myself live. You're all capable of doing it. So I get it. I can take complex things and simplify them and teach them. But I promise you that anybody that's in here that has been a student of mine, a member of mine, a follower of mine, knows that I want to teach you. Okay? Because I know initially if you just hear options and it's all the vocabulary and the spreads and the debits and the credits and the Greeks, all that stuff is intimidating and overwhelming. But it's not what it's for. It was designed that way so it sounds smart. But when you take away you peel back the curtain on option trading, it's really just a way to express, am I bullish? Am I bearish? Am I trading the market sideways? And that to me is the best thing ever. And that's what I like, is if I can help equip traders with enough tools and strategies to understand, if they think the market's going bullish, how do you position for that? If you think the market's going bearish, how do you position for that? If you want to trade the market with indecision, how do you position for that? Because literally there's nothing the market can do now. The market can go up, down, or sideways, and you have a trade for that environment. And you trade that trade. So it goes back to the famous, truism, which is plan your trade and trade your plan. Exactly. So if we think that the market's going to go up, we can trade it. Go down, we can trade it. Sideways, we can trade it. And day to day, or month to month, or quarter to quarter, or year to year, it's a combination of that stuff. Market's just going to go up, down, sideways. Okay. All right. So we'll keep an eye on this for the rest of the day. This is daily profit play running. So I'll watch. Gamma levels to me, 66.50 should be about the lows. That's our retest of Friday's low. Maybe we get down there, after having that little surge on Friday. Okay. Keith, here's what I ask you. this is my final point to you. I don't, it seems like if I have traders that are looking for more information, I do a lot of small workshops, group individuals that do one-on-one sessions with me. I do workshops of up to 10 people, and we just open up the microphones and the cameras. We get to know each other, and we talk through the markets. Like I said, there is nothing that you could bring to me that it's I'm not going to try to help simplify or make sense of, as far as how we can trade these markets. And I would say, and I've done this before. I'm trying to think where this was in my Telegram channel. Let me find it in Telegram really quickly. If I search in here for must have, pretty sure insurance must read, perfect. No, that's not it. Must have go to. Nope. That's in here somewhere. Let's see here. All right, let me see if this works. There we go. Okay, here you go. This was just a couple weeks ago. I put in Chat GPT, explain to me like a 14-year-old how to trade a bull call spread. And you can do the same thing for any of these strategies, right? A long call, long put. Brokers say, congratulations, Keith. Congratulations, John. Congratulations, Mr. and Mrs. Smith. You can trade options now. And what does the broker give you? The most basic permission that sets you up for essentially failure, where you're trading against the markers and you need price to move a certain direction over a certain period of time, quick enough to get you paid and cover what you paid for that trade. Traders are set up for failure if all you're trying to do is survive on buying calls and buying puts. So I like to take the risk out of these trades. I like to take the uncertainty out of these trades. I like to take the time hurt out of these trades and add some more to my arsenal. Okay. So my point is, if these are things that right now might sound intimidating, but these are things that you're open-minded and willing to learn, I promise you, you will be a better trader for this. Long calls are fine, but they're basic. Long puts are fine, but they're basic. If you don't manage them often and take base hit profits, you are going to lose most of the time because market makers are smart and the markets are efficient. Okay. Bull call spread, take away some of the time factor. It's a debit spread. Bull put spread, it's a credit spread. Okay. I've done a lot of strategies on these where you just have to understand, like, where's our break even? If I do a trade that is a bullish vertical spread or bullish debit spread, do I know my break even? Where do I make money in the trade? If I do a bullish credit spread, do I know where that break even is? Do I know where I make money on the trade? And that's why I keep going back to, this is stuff that I've taught for years. My practical options, I built a course that's foundational education for somebody that doesn't know options. How would I teach somebody from scratch how to get involved with options and make it very applicable to any market condition? If you want to trade up, down, or sideways, do we have some strategies that we can start understanding? So I go back to this telegram here. It's like, these are things that I think you must know. These aren't that challenging. It's just understanding what strikes and legs do I put together to build out a combination that lets me say, if price is here, I make money. What's my probability of profit? What am I risking? What's my reward? You know that stuff ahead of time. You're playing the game, right? You have defined risk. You have defined reward. If you stay bullish, typically you're going to get paid to get bullish, right? So long call, long put, those are directional. Bull call spread, that is directional. It's a debit spread. Bull put spread, that is directional. It's a credit spread. If you don't know the difference, it's not a big deal. Okay. One is going to be a debit where you pay for that in your broker platform. One is going to be a credit where the broker gives you that up front and you just need price to stay above a certain line in the sand to make money. Today, for example, I have a bull put spread on SPX. If we stay above 66.20, I will make $100. Okay. Bear put spread, same thing in reverse. If I want to be bearish in the market, this is a debit spread. I need to know my break even. This is a credit spread. I need to know my break even. It takes way less movement to be correct on a bear put or bull call. It takes way less movement on the underlying asset to be paid and get profit in a directional spread trade versus a long call, long put. Butterfly spread. This is where I start to lose people. This is where things get really weird. It's the combination of 1, 2, 1. I get it. It's weird. They have silly names. They have stupid strategy names. But if you break it down, all it is a combination of these other spreads. And this one, butterfly spreads, are some of my favorites. If you follow myself or follow Kane, I run an entire service around butterfly spreads. And the reason why is because it's one of the only strategies that provides like 5-to-1 reward to risk, 10-to-1 reward to risk. There's hardly any other strategy that gives you that and understand like where price has to be. You can put a trap in the markets where if price is within, like if I have a center price and today I'll just call an example. I'll say, okay, 6,700. I could put a trade on today where 6,700 is my like center price. And within 20 to 30 points of that, if I'm somewhere in that net or that trap, I can make money. So anyway, high reward, low risk. And some people love that because most people are terrible at managing risk. Kane, what's up, dude?
Oh, I'm here. How's it going, dude? Thanks for covering. Sorry for being late today. Had a couple things.
All good. All good. So I just was sharing a little insight. Keith sounds like a trader that maybe doesn't have the right broker permissions and asking for, the broker says they want 5 years experience. I get it, man.
Yeah.
And unfortunately, if you've already kind of solidified the investor profile, that broker might have you pinned as like, this is a trader that initially said don't have 5 years experience, so we're not going to update the profile. Look, I've been in that situation. I've seen traders that have 0 trading experience, but I know that there's a magic profile you can fill out where it's like, you're okay speculating and trying to aggressively grow your account. If you express 5+ years experience, 10+ years experience, they will give you whatever permissions you need to take all these trades. It doesn't mean you have to all of a sudden start trading them. It just means that the broker is going to lighten up on the restrictions. And I do think as a trader, you all deserve to have the best permissions possible. You should
Yes.
never, ever let a broker determine or dictate what you can and can't do as a trader. You don't have to take any wild, crazy combination trade, okay, until you learn how to do it. And then you can trade however you want. But to just be given the basics, buy calls, buy puts, I don't think it's good enough for you. I don't think that's good enough. And it's not setting you up for success when you can just understand a little bit more of the combination and you play chess. And don't let a broker tell you what you can and can't do. It's not fair. It's not fair to you. Permission is going to continue to get better, right? I mean, right now, Kane, we had to talk about this morning. I have some traders that I had a gentleman that reached out this morning from South Africa, and I have some traders in Canada. Everyone's looking for a good broker. Everyone's talking about, well, my broker charges this and my broker charges this. The best deal that I've heard of is, I think it's $25 to $35, and it's a flat rate. Have you heard of this? The Tradier's like the one broker that I know does flat rates. Yep. Mm-hmm. But are there is there something that they're not telling you? Because that seems a little like, if you're an active trader, I mean, I've already posted, I've taken 58 trades today. I mean, Tradier already is losing out.
Yeah.
Right. Like if they're like, yeah, this guy's got flat fee at $25, I'm already $50 ahead of them in fees. Yeah. So there's got to be something that they're getting, and I don't know if it's order flow stuff. I don't know if it's bid ask.
Trader accounts.
I mean, is there something that they're not telling you for that type of setup?
So my experience with Tradier is, it's the flat fee. Their execution isn't as good as what I get in other places. So that's probably one place where they're making it up. Number two, their software is slow. When I switch to an option chain, I'm waiting a few seconds, and then I say I want to buy this. I'm waiting 1 or 2 seconds for it to pop up. So if you're trying to do zero DTE stuff, you're trying to act quickly, then it's probably not the broker for you.
Gotcha. Okay. And as I said, to me, it was like, that just sounds a little too good, right? And it's like, there's got to be something. There's got to be a catch. I mean, Robinhood was free trading for everybody, and then it turns out they were getting paid for order flow, and there's a whole thing with Melvin Capital and Citadel, which blew up in 2021. But they survived, and Robinhood's very, very healthy, and the stock's blown up a ton, which is great. But it's like, I'm just skeptical. And I mean, I'd love for my fees to be lower, but one thing, look, until this is truly democratized and truly free, options you pay for, and futures you pay for, and Forex you pay for. It's like, you can literally buy a stock for free and nobody gets charged commissions on that. You can buy an ETF for free. You can do a lot of things that they don't charge for anymore. But options prices have to go through clearinghouses where you're going to get charged something. And you might have to pay $1 for that. And then eventually you can negotiate where they might listen and let you lower that to 40 cents, 50 cents, 60 cents. But you got to prove that you're an active trader, and they'll do it. But it's a cost of doing business. I mean, generally, if I'm making about $100 a day, I'm probably going to net about $95 or $96. And that's fine, because I can't find a way to replace that other $4 or $5, because that's the cost of doing those trades. Yeah. And, but I can say this, look, for the profits I have right now, I've had about $20,000 in fees. Okay. So 20K out of 437. So I paid about 4.5% of my profits into fees, but I'm keeping 95.5% of that. That's a lot better. Like when I ran a currency fund, I was more like 12 to 15% was tied up in spreads and negative commissions if I was in a bad position. Yeah. So I'm thrilled that only about 4.5% of my bottom line is going to the broker for just letting me trade how I want to trade. So anyway, I'll say there's another day, but it's important to know, like, there's no free lunch. Like, trading is trading, and there's fees attached to it. Some brokers are better than others. My job is not to refer you to anybody. I'm just saying, like, you see Kane trade from his platform, I trade from mine. I've been with brokers that I've been happy with. I've migrated brokers literally my entire career because I refuse to accept that this broker is going to be, the only person I can trade with. And I feel bad for a trader that only has like a one option trade. Like, Interactive Brokers might be the only name in the broker landscape for you, but take them if you can trade and do your best with them. And if things improve, great. Or if another broker offers up permissions to trade, like, be open-minded. So it's always an inconvenience. I mean, I've lost months and months of trading over the course of migrating capital, but you do what's best. I mean, I don't want a broker to dictate what I can and can't do. It's that simple.
Yep.
So anyway,
Completely
Kane,
agree.
what do you want to talk with, man? You're catching up from last week. How things going, dude? What's your state of the market right now?
Good. I'm neutral on the market right now.
Okay.
Last time we talked, I was about 50% cash. Now I'm about
Yep.
80 to 85% cash.
Look at
So
you. Okay.
I'm not
Uh,
liking, I'm not bearish, but I'm not
yeah.
bullish anymore either. Yeah.
Interesting. Um, I am curious. So I thought a lot about just kind of end of the year stuff. I think 2026 will be. Uh, I think it's going to be a noisy year, to say the least. Probably noisy is a pretty safe word. Um, we're coming off of so we had a pretty decent 10-month correction in 2022. The market has been from the 22 bottom, very bullish through 2023, very bullish through 2024. We survived the Liberation Day fiasco through 2025. It's been bullish since. Market's still hanging out about 14% year to date. That's a pretty good stretch for a 3-year run. Do you think that a bull market is done and over with? Are you like, and I'm saying this because like you strike me as like pretty realistic, pretty data driven. So I just think there's too much extremes of like it's bubble and everyone run for the hills, or it's this is going to change the world. You need to be super bullish. Like, where are you at? Like on the spectrum of like bullish or bearish, you're kind of neutral. Like you're not bearish, but you just have some cash, like looking for opportunities. Yeah.
Yeah, and my problem is that I'm not seeing a lot of great opportunities, which is why I'm in
Yeah.
cash. And
Okay.
the argument for super bull or super bear, I just take what the market's doing and the price action. I'm not trying to forecast a year or two into the future. I'm saying, like, do I get opportunities? Does it make sense to deploy my capital here? Am I getting good reward risk ratios and
Yep.
expectancies?
Yep.
And if I'm not, then I don't deploy my capital.
Yeah, for sure. No, that's good. I've been playing a lot of defense. I do think here's just some of the themes that I'm addressing for 2026. So I still think that let me ask you this: in the state of like the credit markets, Kane, do you think that we're going to see the Fed ease into 2026, like actual like a QE expansion a little bit through 2026?
Ooh, yeah, I think they've sort of painted themselves into a corner right there.
Yeah.
I think that they might have to,
Hmm.
but it's going to be painful. That's if it happens, it's definitely going to be painful.
So if they do that, have we already like so here's let me see if I found this here's a slide deck that I did earlier today. Um okay. So this is where I think we are at. I think that the pivot that we saw this year is we're into this. We went from once we got out of the April lows, everything turned to this.
Yeah.
Grow baby grow, right? So we were seeing China spend money, US spend money, Europe spend money, deficits growing, PMIs rising, yields rising, long into the curve rising. But this is what's hopefully supposed to help get us from this K shape, okay, to then maybe fixing this as an E shape, something where we can just kind of, the top continues to be the top, but the bottom can get a little bit of help. Um, do you think that we're already past that? Do you think that this was like our effort to grow as quickly, like, oh, the Fed's going to do QE and we don't even have a growth? And now it's just we print and we're all of a sudden like heading towards fourth turning?
That I am a little concerned about that because if you
Okay.
look at all the efforts so far, it hasn't been sector like across many sectors. There
Right.
hasn't been breadth to it. It's been
Right.
very concentrated.
Yep.
So I don't think the lower end, the like your staples and your more defensive sectors, they're not playing ball. So it's going to be difficult.
Right. Um, I'm certainly way more skeptical of tech going into next year. I think that tech has kind of led us out of this recovery from the April lows. I think that tech will also lead us into a pretty aggressive rotation that could make things really messy here in the next 12 months. Let's go out to December 2026. I feel like a month or a year from now, I think we could see some pretty aggressive rotation. Do you think that the government is like kind of literally handpicking who they kind of want to be cream of the crop?
I don't think
Like, I
so.
mean,
I mean,
yeah,
first time ever you've seen
yeah,
government directly invest like in the stocks of companies. I think
right,
that's a pretty clear signal.
right, yeah, and to that degree, it's like, I mean, is it just kind of the close your eyes and trust they've got the backing? I mean, I have a hard time doing that. Like I was long Intel before it became a government stake of, they took a 10% chunk in Intel and it ripped up from, 18 to $30 or $37. I was already in Intel. It was just
Yeah.
because I thought in this chip space and this AI place, if they catch up, it's like I literally got into Intel with like a 1 or 2 year horizon. And within like 3 to 6 months, it's like, holy crap, the thing almost doubled, you know? Not what I expected. And it's like, honestly, I had some shares running that were doing great, and I had covered calls, and I had some other ways that I was lowering my cost basis. But it's like, yeah, I'm already kind of out of the trade. Like I kind of got out of what I wanted. I don't think I need to hold it long term necessarily. But anyway, I'm looking at year to date. Okay. So let's compare like year to date, where right now it's like consumer services, which is heavily weighted on. Okay, we've got Meta and Google at the top of the food chain here. Also Netflix. It's two
Yep.
two big companies. Netflix not too far away, with also a pretty good runner, but it's mostly biased to Meta and Google. Um,
Yep.
if we go, so if Mag 7 pulls back, communication services give back some of the gains because of the weight. If you go to technology, 23.92. Guess who's top of the food chain in technology? Kane, you know this. Who's top of the food chain?
That's going to be Nvidia.
Yeah, Nvidia and Apple and Microsoft and
Yeah.
Broadcom, other top 10 stocks, weighted and crazy bias. So I don't think there's a way to avoid, if the market's going to move away from a Mag 7 rotation, it's going to be painful.
Yeah.
It's too big, it's too concentrated, it's going to be painful. That is what 2025's correction started out to be. February to March was actually a Mag 7 rotation, not a Liberation Day tariff war. And I think that the trade war stuff is what kind of accelerated the downside, but we quickly pivoted. But it started off initially as it was a rotation. So anyway, I don't know how aggressive the rotation is. Do you have any sectors that you like? If we go away from Mag 7, like what do you like, Kane, if anything? What is your kind of what are you looking at as far as if you're going to allocate, what sectors would you be in? Are you just going to wait? Do you want to just get discounts on indexes? Like what's kind of your plan for waiting at 80% cash?
Yeah. At the moment, I'm looking at healthcare, but
Yep.
healthcare is a little overdone at the moment. Like if you
Yep.
looked in the last week or so, it's really gone up.
Yep.
So uh, the also utilities, and I'm still bullish nuclear stocks. I'm
Okay.
just waiting for the right time to re-enter because it
Okay.
has had a pretty sharp pullback.
Individual stocks. Do you have anything on uranium? Have you played uranium at all, like physical or spot price?
I have played not physical. I
Okay.
played individual stocks related to uranium.
Okay.
Uh, I'm,
I got out of. I had a pretty good position for the last couple of years on URA. This was
yeah,
so. I mean, my measure move was up here towards 65. Once we started to blow through this like 50 some level, I was long to symmetry here towards 42. That was my take profit was the $40 handle. So I had this is back in 2022. So I've been this for a stretch, but had a nice chunk, got back in, had a nice rip, hit my symmetry. It obviously is blown through that. I don't want to touch this. Like honestly, that might be the only time I trade it,
yeah,
unless we come all the way back down and find a trend. If we're
yeah.
back down to to this level, then maybe. Any what other energy plays you like in? You just want the exposure. You want individual stocks. Is there like is it a nuclear? Is it a natural gas? Is it an oil and gas? Like what physical side do you like?
Yeah, I would go just individual ones that are outperforming the
Okay.
sector. So more in the utilities space than the outright energy space.
Okay.
And then uranium right now is not looking good at all. I'm
Yeah.
waiting for some sort of bottom on that before I go
Okay.
back in there.
Okay. So the AI stuff, the data center, utilities wise, I think that natural gas could be a sneaky winner. UNG is one way I trade it.
Yeah.
It's a pain in the butt to trade this thing because it just ends up going lower and lower and lower.
Yeah.
I'm not looking at this long term at all, but I am in with a very, very deep in the money call. And if we go up here towards $20 to $22 again, this is a previous high around like 24. I'm probably going to dump my UNG position and just take the profit. It's more than double if I get there. I'll take it. I'll be happy with it. I also think that on oil, I have a futures trade on oil that if we stay above, it's mid-December expiration. If we stay above $50, I get paid. It's like a $220 income trade. I've got a $500 profit trap in there. but I think over the next 30 days, like it's probably looking pretty good. Here's my trade actually. So it's just here's CL futures. There's my trade. I took this for Project Options Edge. We're up $190. My max profit is 220. The reason I'm keeping this trade around is because I have a 98% chance of profit right now based on the options and the out of the money percentages. And I have a 50 cent or a $500 profit trap built in. Even if we're going to push lower, CL, which is my futures feed, CL would have to push down into fresh lows in the next 30 some days. This trade expires in 29 days. So I mean, oil would have to drop 16% in the next 30 days. I'm not saying that it can't, but I'm saying that it probably won't. So I think it's going to be a good income trade. But I was going to point out on oil. I like natural gas, but I do think oil is probably set up for more bearishness ahead. I actually have this. And if anybody is like a currency trader or you like the technical stuff, here is a fancy pattern. Let me change this to black. This is a harmonic pattern. If you go from the ridiculous, like negative futures prices that we had during COVID, and then you rip all the way up on the swing, there's your low to high. You go X, A, B, C, D. If we have that type of symmetry, Kane, I think that we make this problematic. If oil prices get down to sub 50, sub 40, it's going to cause a lot of problems and a lot of pain. I think the break even for most of the world is around like the 50 to 55 handle. So I think if we do push down there, it's like, I just think there's like baked in demand. This isn't an all-in trade, but it's certainly like I would take a decent stake at oil at 40 or sub 40 and probably dollar cost average in for, I don't know, a 3 to 5 year outlook. I think that's a trade that could be I don't know, 50 to 100% upside, if not more.
Yeah, I think so. I mean, if you get that low, you're probably already deep into a recession, and then or at the very beginnings of one at least. And then how low does it go during a recession? Well, we're not talking about shut down and no one can leave the house like COVID. Correct. So it's probably going to hang out around there. Yeah.
Yeah. So, I mean, if you want to look, this is just simple tracing to the charts. I take my low and my high, I drag a symmetry measurement. That's what this yellow box is. I think if oil gets down to, 37 to $36 here on US oil, I'm probably going to dollar cost averaging at 40, 35 if it exceeds my symmetry, and $30. And I'll put in kind of I don't know. I mean, I could buy USO. I can trade, individual energy companies. I can trade XLE, but I like just also CL. If I went like long futures, I could do it with options. I could take it to find risk. I mean, what I'd love would be if we get trades in here and I go out like maybe 6 to 12 months and just do a simple like debit spread. That debit spread could pay me probably 100% or more on every trade that I take over the course of like a 6 to 12 month expiration if I stagger them. So that's kind of what I'm thinking as far as generating some income versus just like buying and holding like a stock.
Yeah.
So anyway, just something on the radar for oil. Yeah, I mean, if we slip below 50, I think we're on that brink of recession. We're already possibly in one. Also, it's like I think lower oil prices or steady oil prices have been a big contributor to why inflation isn't higher than what it already is. Give me some sense, Kane. 43 days of a government shutdown. Are you happy that we're back online? You happy that the government's back?
I guess. I mean, there are a lot of things that are dependent on that government funding and government running smoothly. Yep. So yeah, if you want the orderly rule of law society, then you need the government online and working. So so it's good news that we're working. But then you say, okay, well, this was a stopgap until January, so we get to see it all again in January.
Correct.
And the markets didn't really care when we shut down, and some people attribute the timing of the Friday gap down with the news of us reopening. But I don't know. To me, if you didn't react to it shutting down, then the news of it reopening isn't really much news either.
Yeah. So, I thought that this slide to me was the what was the saying I heard this weekend? Fatigue makes cowards of us all. I don't know who that quote is from, but that's what I heard in a podcast this weekend, which is true because I think the one thing that is exhausting and that's fatiguing investors would be sentiment. And the fact that we've had the longest shutdown in history, we have so much uncertainty. Are we going to lose all of our jobs to AI? Blah, 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 blah. I thought the biggest news that contributed to this sell-off was and again, I think it's a bit of an overreaction, but if you go to the watch tool for the Fed, this
Oh
actually
yeah.
pivoted to now the probability is the Fed doesn't do anything in December. I think that's where the
Yeah.
market was like, oh crap, they might not cut rates. And so this like
Mhm.
baking in a 3 rate cut, September, October, December might not be the thing. However, give it a month. And if you go into January
Right.
2026 and they cut rates, it's like, who gives a crap what happened in December? I also think that the markets, look, I don't think the markets generally want to see a bearish December. Nobody wants to see a bearish November. Nobody wants to see a bearish December. And if we do see one, I still think there are backstops and animal spirits to kind of, maybe stall or stabilize. But yeah, I just think right now it's like the market mood is like it's a bit exhausted. The price action. Here, I have to zoom out a little bit here on my charts. I mean, and Ken, if you want to show anything, like feel free to jump in. Let's take a look at some stuff that you like. Here's a chart that I just had, going back to like May of 2020, 2025. Okay. So we just connect the dots. Well, once we started flirting with all the structure here, and you can see like, okay, it started here, support and support and support, and then it broke, but it was hugging the trend line still, and we broke all-time highs. So it becomes like this sticky trend line. We broke
Yep.
through it. We came back to retest it. So this trend line has acted as not only support for all this time, but it also acted as resistance here. And
Yep.
I've been talking about this like from a pretty clean technical standpoint. I do have a concern if price breaks the October 10th candle. If price breaks below that, I do have concerns that this market will probably slide a little bit lower, because I don't think there's much to hold us up if that low gets taken out. This was, escalating the trade war stuff. Another noisy tweet. The markets did the market breadth was garbage when we reached all time highs right after that October 10th break, right?
Yes.
So that concerns me that market breadth is terrible right now, and we break below this. If we take out a key level here, I think that there's just more to give back, and you can take the bigger swing, go all the way out here. Let me go to bigger chart again. Take the entire swing from April's lows to these, October highs, and just look at one big fat Fibonacci. And it's not a perfect science here, but within reason, if we take out this October 10th low, all we have are some fibs that are much lower. And I think if we threaten this level, then we fall to 64, 63, maybe even 61.50. And that's the next real test for the market to see, does this past resistance become support? And I think, Kane, you can correct me if I'm wrong, but it's like it becomes a pretty delicate environment when, oh my gosh, we're down 900 points from the highs. What does this mean? Like, I
Yeah.
think that's going to put the bulls on their heels for sure. And the bears are like, we'll just push you guys off the cliff and see what they can do with it. So I think it
Yeah.
becomes very, very delicate around those levels. But if we stay above this October 10th candle, and this is just a noisy little area, then, this looks a lot like December and January last year before the market rolled over in February, March. Indecision,
Yeah.
you know? So,
The thing that just came to mind is, Michael Burry. He shut down his
yep, yep,
his hedge fund.
yep.
He may have just the worst timing ever because if this plays out, he could have recovered at least some. So
Oh, dude, I know. And, I feel bad for the guy. I mean, it was, dude, that post you made in Slack was freaking awesome, where it's just like, yeah, he's had some pretty bold calls. It's like, I know. And I think what's crazy is like, I don't think he is an emotional guy. I think that he does the numbers, he does the math, he has the data, he has conviction, and he gets in. I just think it's a terrible all-in trade. If you're all in
yeah,
on the bear, it's
yeah,
like it's a
well,
terrible all-in trade. And yes, you were rewarded during the Great Financial Crisis, but I posted that YouTube video for us to see. I mean, if you checked it out, but the
yeah,
actual like Vinny and Porter inside of like it was like Steve Carell's character. I think it's Mike Baum was the name of that office. That was like in the arm of J.P. Morgan. They had their little hedge fund. Anyway, Vinny and Porter in that office, but they talked about firms that they knew during 2006 and 7 were also in the short, like they were in the short positions, and
yep,
they didn't survive. They actually went bankrupt. They lost everything trying to short the markets. And Burry, it's like, look, the guy's probably still fine, but he's clearly made some big calls and he's become really famous for it. And the market listens, but now he's deregistering, right? He something didn't click where it's like his math, his decisions, his all in, his risk management have not done well and fared well with this like irrational market that's like go up forever, buy the dip. And he might not be wrong, but it's like, Who knows, dude? I mean, I thought about a couple things this weekend. What if the next big crash is the 100-year celebration of the Great Depression? What if that's what the market feels like doing in 2029? Right? Like we get through an election and it's 2028, new president. If Trump can survive the midterms, and I think another thing for 2026, I think you're going to see a kitchen sink approach to 2026. I think Trump plays the markets like it's his scorecard. It's his best way to say, like, look, we're all-time highs. Everyone should be happy. There's no inflation. All-time highs, all-time highs, all-time highs, right? Whether it's his family doing it or it's the stock market doing it, it's like it's something for him to brag about. It's something for him to say, look, our economy is a reflection of the stock market. It's not the economy, but it's a reflection of it. And I think 2026 should be like, in order to sway voters, keep the party going and keep the wheels greased. If the Republicans lose the midterms, which is why I have a lot of concern, like if I'm going out 12 plus months, I have to take consideration into like the midterm elections potentially being like pretty nasty, and being very volatile. And then you go out to 27, 28, it's just a big fat question mark. I have no clue in those 2 years. Like, yeah. And I don't want to go out that far. If I'm going out to 27, 28, I'm just going to have gold and silver, and it's just going to be a percentage allocation. But it's like, I don't want to go out that far. I think for me, I'm pretty stable, let's say, for the first half of 2026. I think that the markets will, like, I think October 10th was actually a bit of a de-risking. I think it was a bit of a deleveraging. The crappy part, it was the one-day move. It was a one-day move that kind of de-leveraged the market. But we, hit all-time high shortly after. I just wonder if now you have some of the loose hands getting shaken out. You have some of the leverage out of the market. Credit spreads aren't widening a ton. Am I wrong? Or do we have is there something you're concerned with credit spread wise or
no,
credit wise?
Credit's so far so good.
Yeah. So anyway, I don't know. I mean, it's hard to pin any of this stuff and say this is when it's going to happen. I would be cautious. I think 2026, after having 2023 bull market, 2024 bull market, 2025 recovery and bull market, 2026, I'd be totally happy, Kane, with just like an income-based year where if all I did was generate, income on covered calls, income on, like basically naked puts or put condors or something where it's like I can give myself, 10, 15, 20% discounts in the market, still generate income, get assigned little to no shares of anything, and just churn, month after month, just making some pretty good income. Like that's probably what I'll do. And if price shows me it's doing something else, then I'll switch my tact a little bit. But I'm going in like with a pretty like sideways tone to 2026.
Yeah. I mean, and I totally agree. 'Cause, I mean, I said that I'm neutral on the market right now, which is basically saying the same thing in different ways. Like we're expecting chop, probably not a whole lot of direction. And if you're not doing income style trades, you're going to be severely handicapped, which was another argument circling back to when I first got on. Chris was talking about having the ability to put on any type of spread that you want to inside of your brokerage account. Otherwise, you're not going to be able to take advantage. You're just going to get chopped to heck. And then if you're in options, you're going to lose out on that time decay.
Yeah, agree. And there are some pretty good premiums. So I had a new account come into me today. And so I did some deployments here. I'll show you what I'm working with here. So I started out with a little toe in the water. I'm dipping into golds. I've got some ratio spreads and some puts on GLD, did some Bitcoin. I bought 200 shares. We're already down a decent amount. Like Bitcoin's, 20+% off the highs, which is probably not super exciting because we've had increased money supply and yet Bitcoin is sliding. Qs are down, but Bitcoin is, it's not doing great. IBIT, which is your BlackRock ETF, that kind of looks like it. I mean, we're at fresh lows today. Here's spot price. I mean, I said this the last couple of weeks. If we don't hold 100K, there's room down to like 90 and 85. I think that is a pretty important level to hold because if we're going to maintain some type of channel like this, this goes back to, basically the trend of that kicked off in 2023, connect the dots. I mean, this trend line in a channel, it's important to hold, man. If it doesn't hold and we come back down to like 75, I mean, there's an outer trend line, but be prepared for like a pretty ugly drawdown. If we come back to that outer trend line, we're talking like a 50+% pullback. And I'm not saying that that's something that is unmanageable for Bitcoin. I'm saying it's a lot tougher when it's been, market cap up to nearly $2 trillion. And all of a sudden it's like, oh, it's down 50%. It's going to make people double think, take a double look at those allocations, right? Now that financial advisors do it, now that every broker can offer it, like it's become more mainstream. And I also wonder if this is a pain point of all the financial engineering that's been being done around Bitcoin. Look at how many,
Yeah.
ETFs and yield max ETFs around leveraged Bitcoin and around MicroStrategy and around ways to generate 8% yield. And if Bitcoin goes up, it allocates into Bitcoin. It's like, well, Bitcoin's down freaking 30%. So who wants Bitcoin right now? Nobody. Like right now, it's like people are fleeing. And honestly, if you've been holding this thing for the last couple of years, yeah, you don't need 20-30% Bitcoin allocation. I mean, I've been pretty happy with like 3% allocation that has grown at points up to like 8 to 10%. So I typically peel that stuff back. I'm pretty comfortable in my own portfolio with like a 5 or 10% Bitcoin, but I'm selling a lot of premium around it. Just today I did this on this account. So I bought 200 shares of IBIT. I sold one call to cover half of this trade and lower my cost basis. So right now, I bought shares. My break even's 53.34. I collected $6.60. That's half the shares. So I lowered my net cost basis on all of the shares down to 46.74. That's my break even on the shares that I have. So I can let 100 shares get called away at 53, which is just above current price. I can let the other 100 shares just ride. And allocation wise, that is not tying up a ton of capital. Let's say it's tying up about $5,300. So $5,300 out of fresh account balance. I'm looking at about a 2% allocation. I'm comfortable starting there. If I want to buy some more Bitcoin, I would do it at another hefty discount. Probably do the same thing. I'd take 100 shares, generate some income on it, 200 shares, and let one run free, and then figure out my cost basis. So, I'll stay the course. I think about a 5% allocation is comfortable for me for client accounts, and that's it. And then of your 80% cash, I'm over 50%. And
Yeah.
a lot of what I am allocated though, it's like it's dude, my stuff is so far out of the money. Like I'm using April lows as a lot of my like levels. Like I'm going out to trades I put in literally this March or April. I put trades out to December and January that were all like 480 spies and 400
Okay,
Qs.
nice.
And I'm still sitting on those trades. Like those are all in my, like, they're just going to expire in the next 30 days and they're all profitable. So going out to like, now that the VIX is over 20, what I've done for like Project Options Edge is I'm just selling premiums using those April lows. I did a trade. I'll just go back to the same thing. This is a brand new account, so I'm doing some allocation. Here's a trade. I did a ratio spread today, 510 by 480. So I have a $3,000 profit trap in here, actually a $6,000 profit trap because they're 2 and 4 contracts, $3.38. So it's an income trade for $338, which would be around $700 profit. Also, if I took shares, I wouldn't get assigned the SPY until it's back under 480. And I mean, I don't know if you know where 480 is. 480 is below the April lows. 480 minus a $30 bonus trap minus my $3.38. I would own my shares of the SPY at 446. Kane, if you could own the SPY right now at 446, would you sign up for that trade?
Absolutely.
Okay. I thought so.
Definitely. Yeah.
It's a 34% discount from all-time highs. So number one, the probability of profit on this trade you can see is 99%. I don't think I'm going to get stopped out. I don't think we get assigned. I think it's just going to be a steady income trade for $700. Yeah. But if I was assigned, this is one of my favorite things is if I'm going to own shares, I'm going to own shares where I'm happy owning it. And it's not at all-time highs. I have no interest in owning shares of the SPY or the Qs at these current levels. We could easily see 10, 15, 20% fluctuations in the market. To maybe have a break even year in 2026 and we deal with multiple 10+% pullbacks, who knows? But just not that interested. So yeah, man, I think it's just going to be a trader's market. And I think that I thought 2025 was a trader's market because we had 2 such great years that are bullish, but 2026 is maybe it's better to be a trader in 2026.
Yeah, probably. So there's a question that comes up out of this, and actually this was something that someone asked me during my earlier class in the Weekend Trading Club, and they asked, how do you size up risk? So this is something that I haven't talked a lot about because it's a little bit more of an advanced concept. Because when you're beginning, we just say, okay, do you have one allocation? You stick to that allocation. And if you're a short-term trader, if you're a swing trader, that can work out really well for you. Even if you never move beyond actually just changing your allocation or sizing up your winners. But the truth is, if you want really big winners, and the guys who make it really big on Wall Street and the guys who have the amazing big gains, they size up their positions. I think, was it Green? Morgan shared the latest filings for one hedge fund. I forget who it was, Green something
Yeah.
Capital. And if you looked, their largest position was 65%, right around 65% one stock. And they
Oof.
obviously sized up.
Yeah.
So that's
Yeah.
definitely not something that we normally would say, hey, yeah, put 65% of your entire portfolio in this one stock.
Right.
But they obviously they allocated and they stepped their way into it. So what's your opinion on that? Especially, I mean, and where do you think that you have to be in before you start trying to play that game where you size up on positions?
I think for the sizing up, that's Druckenmiller's quote, which is put your eggs in one basket and watch it closely. I think that's the trade where, look, if I wanted to be 100% spy, I would have a collar trade. I would never, ever take my eyes off of having like downside protection and upside either credit income or have a part of it that can run free with profits and then just protect the downside and also get like futures in for hedging and try to get some high reward, low risk hedging trades. But I mean, dude, I couldn't imagine one single stock. I think it's nuts to me to go single stock. I would rather be SPY. Like Ray Dalio at Bridgewater had at one point in time, like 32% of Bridgewater was in SPY. Like that to me, I think is a little bit more like Buffett holds SPY. It's like that. That's where I would be as far as like an allocation. It's like, I don't mind having like 20 to 30, 40, 50% allocation if you've got options around it. But I'm really skeptical of like one stock all in, just because you never know, man. I mean, I look, you said healthcare earlier today. I took a trade on Merck, which is I've been in Pfizer for a couple of years. I like Pfizer. It's beat up. I think that pharmaceuticals and I mean, pharma with dividend, pharma with growth, low valuations, hopefully like good cash flow. And also if we actually do get healthcare costs going down, if we do improve drug prices for everyone that needs them, I would think, and also this is so AI might be better suited for banks, white collar admin, and pharma versus tech. I think that honestly in 2026, that might be like the surprising rotation where like biotech and pharma, it all of a sudden making headway on like we're going to turn cancer into like a chronic disease versus something that kills everybody. And it might be 10 years out, but the ability to put, the R&D and the whatever you want to blanket it as AI, but it's like, it would be amazing to actually see some real progress in the healthcare space and the pharma space and companies that are, I think we're at like 11 times earnings for Pfizer, maybe. So anyway, we'll come back and circle back to the pharma stuff. But to your point on 65%, I don't think you'll ever see me in a position like that. So to me, sizing up is I'll start with like a half to 1% toe in the water, and then maybe allocate that up to like 5 or 10 if I really love something. But I don't think I'm really going to take any one thing outside of an index and go more than probably 10% for individual stocks.
Yeah, I agree. I think that's a very, very practical way of doing it. If you are going to have a huge chunk, it's much better. Let me close this door. Sorry, it's just I don't know why it opened and slammed. But 1 second. Sorry.
Okay. All right. While that can, I just had a trade open up for me. I'm just going to do a quick label on this one.
All right. Sorry about that.
No, all good, man.
So in terms of sizing up, yeah, it makes sense to. Here's what I say: if your normal allocation is 0.5% or 1%, sizing up means if you're super, super, super bullish, you might go 5x, 10x, right? It doesn't mean
Yeah.
so if I'm 1% and then suddenly I'm at 10%, that's about the limit. You're not going to be allocating 50% plus into a single position.
Right.
So,
I mean, what do you know the ticker in that, by the way? Do you know what that ticker was that was 65%?
yeah, let me see if I can find it real fast.
Okay.
It was Green Oaks. It was Carvana.
Oh my gosh.
Jeez.
Wow.
Wow.
Ugh. Who is that portfolio manager? Oh man, I mean,
That's
I'm just
incredible.
looking at the chart. If you want the screen, Kane, I can pull it up. But Carvana's sitting at the same highs we had from 2021. Man, I think that's a gutsy play, dude. Like you got to believe that are people just like buying used cars left and right? I mean, last time I checked, used car sales aren't great. People are defaulting, and there's it's a building problem. Like subprime auto loans, student loans. Like as these things have come back, it's not looking great, and cars are still super expensive. I think, but right now the fixed income for most people, it's like if you're spending on a house and a car, that probably takes up most of your fixed costs. In my opinion, that's probably a heavy amount of what people are spending on every month.
Yeah.
Carvana, oh my gosh,
Yeah.
dude, that's scary actually. Hey, I wish him well. I'm gonna look at a quick fundamental scan of let me see what Carvana is. So okay, I mean price to earnings 71 times earnings. That doesn't get me excited. Fair value discounted cash flow is 274, and we're trading at 321. So I don't know. Does Greenfield go from 65% allocation to 90% when it's down another 20, 30, 40%? I mean, where do you stop buying Carvana? Is it like, are they going to ride this thing down to $20 again? Um, I don't know.
Yeah.
What makes I don't know. I just like what makes the used car market better right now, Kane? Anything?
But
Do you
if
like
anything,
anything
it'd
in
be,
used car space, other than them being like
uh,
maybe a Kelly Blue Book, but that's a totally different monetization model.
yeah. Yeah. The only thing I could think of is if you're thinking that there is a downturn in recession, new cars go down, used cars go up. But if you're really thinking recession, then you're doing auto parts,
Yeah,
not used
right. You're
cars.
doing the Napas, the O'Reillys,
Yeah.
auto zones of yeah, auto parts for sure. I mean, if I could go long on auto mechanics, I think that'd be a good trade. I
Yeah.
mean,
Yeah.
I took my motorcycle in to get a battery and a clutch put on, and it was like $550, and I think 400 of
Jeez.
that was labor.
Wow.
So yeah, I mean, if I can go along in the world of mechanics, if there's like a union that I could trade for all auto mechanics, and I mean the trade stuff, it's like I go long electricians, I go long carpenters, I go long DIY handyman. It's like that stuff is probably so good in the next 3 to 5 years of just a lot of people overlooked it because it was considered blue collar, but it's a skill set that very few people have, and now they can charge whatever they want
Yeah.
because you can't do it, and you're going to pay whatever they ask you and whatever they invoice you for because your bathroom's leaking and you don't know how to fix it, so somebody's got to come in and do it.
That's an argument for private equity there.
Yeah,
If
that's a
they
whole
have
nother conversation,
portfolios
dude.
of, yeah.
Um, I heard an interesting stat. This was on a podcast I caught last week. That a lot of people that are sitting in private equity are not actually making money until that private equity sells it to somebody else. Like if
Oh,
you want to make money in private equity, you have to pretty much package it up, sell it to somebody else, take on whatever garbage you put in there, and then you get your payout as an LP. Um, in your space and like private equity, it's like is it something that should ever come public? I feel like if we let the retail crowd jump into private equity, we're being sold a bunch of garbage. Number one, but number two, if you take the private side of it where you don't have to go mark to market and all of a sudden you have to get it ready for like the public space, is it really going to show us how ugly things are? If you look under the hood of private equity, I feel like there's more cockroaches than I think what people are giving it credit for.
I would tend to agree, right? It's because you don't know what valuations were in there, and maybe they got in at really great valuations, but if those things aren't cash flowing, then exactly what Chris said, you're just waiting to flip it to somewhere else. So if
Right.
you think real estate is like, can you always flip a house? Can you always flip it profitably? The answer
Right.
is no. There's specific market conditions where you can do that. So if you're not cash flowing or if you don't have that income, what the parallel would be the rental income on the real estate, then you're stuck. Your money's stuck there.
Yeah. Yeah, I don't know. I hope it doesn't come to that. Just stay. It was my biggest red flag was like Yale and Harvard dumping a lot of their private equity from their endowments. It's like that
Yeah.
was a huge red flag for me. And then all of a sudden, it's starting to come more and more public. Like Oak Tree got out of a lot of their private equity. I feel like there's a lot of hedge funds that are dumping private equity, or dumping it to somebody else. Who knows? So anyway, crazy stuff. Let's do where are we at right now? So we've got 15 minutes for the close. I've got a couple trades I'm watching. Um, we were taught, so Carvana, that's so funny on that Carvana stuff. So I mean, let's finalize that question. So risking up or leveling up your risk. I mean, to me, it's all about like toe in the water, dip it in, scale in. I mean, I'll keep it really simple here. Like I will probably always be a buyer of the SPY and the Qs. I think that the Nasdaq since the 1990s has been like by far the best like ETF ever. It's outperformed the S&P. It's not as broad as the S&P, but we are truly a tech and service based economy. So if I looked at this as that's what I was asking Kane if he wanted to own the SPY at $450, would he be interested in owning the SPY at $450 because that would be way down here. And if I were to dollar cost average, Kane, do you think it's possible that in the next 5 years that the S&P is at 10,000 or at 6,650 right now? Do you think that 10,000 is realistic in the next 5 or 10 years?
Yeah, especially when you figure in inflation. Absolutely.
Sure. So let's take current price on the SPX, okay? And let's say that 10,000 is something we can get to. And I don't know, we don't have to put a timeline on this, but let's say, by 2035, we're going out literally a decade, can we get up to 10,000? If we roughly annualize this out, whatever, we'll go to 10,000. We're talking 50% over 10. I mean, it's not making a lot of money. You're making, you're going up 50% over 10 years. So we're analyzing 5% over the next decade. Totally within reason, right? Like the market average is about 8%. We've got, 8% upside is anywhere for 15 to 20% pullbacks. It's the game of up, down, sideways. But 10,000 is realistic. Let's give it a decade. What I was going to say is dollar cost averaging. I mean, I keep it pretty straightforward. I know that, the more aggressive traders probably buying like every 1% and 2% dip. I'm more of like the 5% and 10% dips. That's kind of where I like to start to dip my toe. If we go, let's just say 10%, and then we go 20, and then we go 30. Kane, how many of our corrections have been contained within about a 10 to 30% corrections over the last 20, 30 years?
God, it would be nearly all of them.
Exactly. That's my point. So if we had some dry powder for a 40 to 50%, that's fantastic. But most of our pullbacks that have been crazy, COVID in 2022, each exceeded 30%. The dot-com, the great financial crisis, were between 30 and 50. I think the great financial crisis, GFC, was like 56% from peak to trough before it bottomed out. But we're talking, 1 to 2 of like the craziest busts and bubbles that we've had or the greatest crises we've seen. Most of our corrections have been within the 10 to 30% window. So if I just said, okay, I'm going to have allocations every 10, every 20, every 30%, and just kind of keep a running total of this, look, it's like the market can make a new benchmark. Every time we're at a high, what's 10% from that high? What's 20% from that high? What's 30% from that high? Because wherever those levels are at, I don't mind allocating. That's how I would kind of constantly monitor my risk. I don't mind ever adding more shares, but I want to do it at a discount. And I know that, all-time highs in the markets feed all-time highs. I get it, but it's my least favorite trade. I don't like to buy all-time highs. I'd rather sell puts and let price come to me. I'd rather do ratio spreads and let price come to me. I might never get filled on a single naked put, but I don't care if I'm making income. I'd rather do that than like buy at the highs and then watch a 5 or 10% correction all of a sudden put me in a drawdown, unless I'm buying a high and selling a call. So anyway, that's one way I always kind of look at the indexes, because by design, the best companies, market cap weighted, keep them rising. It is, I do think it's one of the most genius, like financially engineered instruments, which is market cap weighting, because we have seen that you don't have to have 500 stocks to be bullish to make the S&P go higher. You can have 5, you can have 3, you can have 2, you can have NVIDIA literally be big enough to stabilize the entire market. It's not good if all of a sudden NVIDIA rolls over. I mean, Kane, what would happen if NVIDIA dropped 50% in the next year? What's that do to the market? Kane disappeared. Just kidding.
Right. No, I heard you. I just had to close that door again.
Yeah.
So yeah, I mean, NVIDIA earnings is this week. It's
this
coming
week,
up
Wednesday.
in a couple days.
Yep,
so
Wednesday after close.
The point that Chris is making is exactly what I'm concerned about. This is like if NVIDIA goes down, it's dragging a huge portion of the market with it.
Yeah, I agree. If NVIDIA goes down, I think it sets the tone for the rest of the year. I think that the rest of the year is going to hinge on whether we get animal spirits lifting back up to the end of the year. I think NVIDIA is a huge part of that. And, and I don't know. I mean, I don't think they're giving us like super realistic, like cautious narratives. I think that they're very optimistic and they have crazy demands, and they're one of the biggest moats right now until they're not. But I still wouldn't go all in on Nvidia. It's like I think people that have enjoyed the run for the last 5 or 10 years in Nvidia, the last couple of years in Nvidia, it's been fantastic. I mean, even this year, man, even if you bought Nvidia down here, I'm SPY, not Nvidia. I'm going to talk about Nvidia. It's been a roller coaster ride. But even from this year going down to $87 all the way up to 200 plus, it's like you have the largest company in the world that showed a low to high of 146%. This is a $5 trillion company that's moving like a Carvana, a Palantir. Yep. Like that's insane. And it works just as well for you as it does against you. So I think that Carvana, or I'm sorry, see, I'm calling it Carvana. I think that Nvidia this week, it's like, it's going to be important that we technically see some really stable pricing. If Nvidia is going to drop down to 170 or 160 or it's going to drag the markets down aggressively. And if you thought like the peak in 2021 was bad when it rolled over in 2022, I just think like everything that is still leveraged and hanging on by a thread is just going to be dumped. That like nobody's going to want to hang on to leverage if like this can't stabilize the market. So the fact that we are sitting here like at a 50-day moving average, we've got some pretty strong support levels here between 180 and 170. Calculation wise, let's see what the broker has for Nvidia. I think the brokers are probably showing. So let's go through this week's expiration to the 21st. We've got Nvidia earnings on Wednesday. Brokers showing, I mean, crazy high volatility, 1280 expected move. And we're currently trading at 184. So low end of about 171, high end back into about 196, 197. Kane, have you traded a lot of Nvidia earnings or not really?
No, I haven't. I've been touching them.
It usually doesn't do much through earnings. It's usually like kind of like perfectly baked in. It usually is like a big nothing burger. It's usually post earnings that it starts to get some direction. So I think if they beat earnings, so if they beat earnings per share, they beat revenue, and we stay above this, I'd say technically speaking, we want to hold bullish above these levels. If we gap lower and then quickly fill the gap, I think that is a buy the dip opportunity to take us at the end of the year. Again, this is just hypothesizing. Like I just think this is what I watch for price action this week. If we go up instantly and we get back up to all-time highs, I'm still skeptical at the highs, but it doesn't mean it's going to be a bad thing for the markets. If we get back to the highs at all, and we turn bullish on Nvidia for the week or two, next week's Thanksgiving, we drift into the holidays, and we're doing it on the coattails of the largest company in the world that's showing another strong case to take us in and close out the year. So I do think there's a lot riding on it, and I also think that's why it feels like all of this is riding on Nvidia. I think that it's by design. I think it's designed to make people feel like they gotta loosen things up and de-risk and maybe, I don't know, miss out by some type of like rally at the end of the year. What do you think the chances are that the market just absolutely implodes by the end of the year? Like we're talking like 10, 20% correction by the end of the year.
Not super high. I don't see unless like Nvidia just craters and then they're like, oh, we're not doing another rate cut.
Yeah, you take, let's say we get down to the 200-day moving average, which would be, again, like I'm looking at a measured move on options to about 170, 171. If we dump to like 160, I mean, that is another 12 to 13% downside move from all-time highs. That would be a 25% move. I think it would be fair that if Nvidia is down 25%, we could easily see the Mag 7 going right along with that. With that type of concentration, we could see, maybe 12 to 15+% in the S&P and the Qs, if not more. That is the scary part about how concentrated the market is. But what's crazy is we're going to be sitting here this week. We know that earnings are coming on Wednesday. And by the time the market opens on Thursday, we'll see where price is at. And I don't know if you were in the session when I talked about this, but does this price from October 10th technically matter to you right now? Does this like candle low matter to you? The October 10th sell-off we had?
Yeah, absolutely. Absolutely.
Okay.
So the candle high and the candle low were definitely levels to watch. And we eventually broke out of that candle high, but now we're right back into that range.
Yep.
So if we, again, that candle high and low is going to be very important to watch.
Agree. So we're back in. I mean, I think this is like a really important indecision zone to watch. I think Kane, last time you and I talked about some key levels, I was giving the market some credit saying like, as long as we stay above like 63-ish, 62-ish, and you're like, I would like to see it stay a little bit more up above that. And now
Oh,
I'm with you because now that we put in that candle on the 10th, I'm like, yeah, I think that we need to stay above 6,500.
yeah.
If we stay above 65, I think we can stabilize in here, and it might just be some chop into the holidays. But if we break below 65, there's not much stopping us from getting the correction back down to the 200 moving average, and that's a 10% correction. It's still not going to break the market, but it does make me question the market's ability to get right back up to all-time highs.
Yeah.
That I would question. Yeah.
Yeah.
So
Definitely by that time I'd be, maybe slightly bearish and but still mostly neutral.
Okay.
If that happens. So.
Yeah. So all right, are you good on time? You want to go like another 10 minutes? You good on time?
Yeah, I can go another maybe 5.
5. Okay. What is like a go-to neutral strategy for you? If there's a trading strategy, you like to go neutral.
Yeah.
Butterflies?
Yeah.
Okay.
Butterflies because of the reward risk. I mean, but depending on the opportunity also. Sometimes butterflies just don't make sense because it does depend on pinning.
Yeah, for sure.
But sometimes I always compare it to the equivalent or the same break even iron condor, because if there is a significant width or distance that you could have in the butterfly where you would net the same or more on the butterfly, then I'll go with the butterfly.
Okay. That's fair. Are you mostly do you like butterflies on indexes or you like them on individual stocks? Like what do you trade more frequently?
Yeah, indices more.
Okay.
On the individual stocks, I'll do broken wings.
Okay.
I think it's directional, but it could chop for a while before it goes directional. Broken wing butterfly. Yeah.
Gotcha. One of my faves, dude. Do you want to do some of that action next week? So we're not going to push longer for time, but you want to do? We didn't really dissect a broken wing butterfly last time, did we? You did butterflies and iron flies a little bit. I talked some collar trades and some spreads. You want to dissect a little broken wing action next week?
Yeah, sounds good.
Okay. Let's do that. We'll wrap it up here for today in the Gamma Report. Any last thoughts? Any questions? Anything we missed? I see Phil. What about the auto subprime lenders belly up recently? I mean, are they all belly up? I mean, I know Carvana uses subprime, but it's like banking sector is pretty large. Here's one thing I would say. I'm not really concerned when I see JP Morgan. Well, okay, I stand corrected. I was going to say JP Morgan making all-time highs, and look at this crap for the last 3 days. That's not looking great. So yeah, indecision. I can see that JP Morgan at a pretty nasty pullback. I mean, we covered 3 days of drop. Like it took, September to October to drop that much. It did it in 3 days. So that's not a good look.
Yeah.
Goldman Sachs, kind of the same thing. Same thing, man. Like this took a month and this took 2 or 3 days. So, okay. I was going to say like with these giant investment banks at all-time highs, that's what I was asking about the credit spreads. And, we're not seeing a bunch of loose credit conditions right now, but I can definitely sense a bit of pause or uncertainty in the markets. It doesn't mean that it rolls over into bearish. It doesn't. But right now it is certainly flashing yellow. I'd say that's probably my analogy is like we're at a cautious state right now, and it can turn really ugly really quickly, or it can stabilize, and it's like, oh, there's your end of the rally. And honestly, I think this week by Thursday, Friday, we'll know if we're doing a lot of damage to the downside. Santa might not show up this year. It might be a nasty way to finish out the year. That's why I asked Kane, like, I don't think the probability of dumping into the end of the year is high, but this is one thing that was a concern last week. Like, I still don't think that we're literally within like a couple percent of all-time highs, and sentiment is completely bearish,
Yeah.
dude. It is so bad. And this still, as a typical contrarian, I just don't see when everyone is bearish and everyone's worried and everyone's bubble talk that the market just gives into that. I don't think the market really gives into that narrative right away. So I think it's going to drag it out. It's going to be fatigued. It's going to be exhausted. It's going to make traders indecisive. It's going to kind of shake out the impatient traders. And I think we'll thrive in that stuff, man. It's like, we know how to make money when the market's not doing anything. We know how to sit in cash and be patient. You know how to wait for opportunities. So I don't know. It's a time. It's hard to do, but it's a time to stay disciplined. I think that's the best thing you can do for yourself is stay disciplined. Keep to a strategy, focus on the mechanics, focus on risk management, and don't force anything. Don't force any trades. And if you like it, if you got a reason around it, if you got a plan B and C, then take a trade. But Otherwise, I like to show up every single day. This is why I like what I do. It's like I can generate some income day to day, whether the market does anything or not. And I don't have to care for this particular strategy what's going to happen tomorrow. Like I'll just approach it for the day. Like if we stay above 66.20, I'm making a full winner today out of daily profit play. That was by design from the initial trade this morning at opening bell. So it looks like we're good. We got 25, 30 minutes left. Yeah. So let's see if it stays above 66.20. I have a defense trade down there if I need it. I don't think I will. But anyway, we'll see, man. So, all right, Kane, let's do, I'll put a reminder here for Broken Wing Butterfly next week. Anyone watching, make sure you remind us next week. Hey, guys, you're going to talk about the Broken Wing Butterfly. We'll deconstruct that, get a couple trades in, or at least we'll talk about some trades. I don't know if we love them or not, but there's a lot of ways to do it. So, Kane, final thoughts, final parting words?
No, everything that you just said, I think it is perfect. Watch your risk. At this time, there's a reason why I'm mostly in cash, and it's just not a high probability environment. So, the way to get around that is to get trades in is to go shorter time frame. Zero DTE is super popular now and available. Wasn't a few years ago. So, take advantage.
For sure. Do take advantage. Okay. I think we should have some type of slide for us, Kane, where it's like, how do people find you? What's the best place to, your services, mine, same thing. Like we'll do that next week. We'll put something together where easy to get people on board. If you want to jump into Kane's services or mine, or, trade with us every day. Kane, do you run a daily session, by the way, right now? Do you run a daily session through the week?
I do not. I don't have enough support for that eventually.
You're just not a one-man shop like I am, dude.
Yep.
So I do this daily profit plan. I do every single day, Monday through Friday. So, the trades are all live. It's in in Telegram for the members. But I do this stuff every single day. So if you want to see some of the day-to-day stuff, this is free. You can jump into my daily profit plan at 9 a.m. I push it out to my Telegram channel. It's in YouTube. It's youtube.com/financial wars. Look, if you're not familiar with options, it's going to be a little bit like you're drinking from a fire hose. But if you're a member of the service, we have master classes every single week on all these strategies that I teach. So I'm just asking because I do run stuff every single day. I'm here to dissect the market and take a tactical trade. I like it. Most of the time we win. We've been on a nice little win streak here, and we will keep grinding. Regardless of what happens, everybody, we're going to find a way to trade through it, right? Like the markets will reward the persistent. It'll reward the survivors. It doesn't reward a lot of like crazy YOLOers that maybe get lucky and give it all back. The market's been full of bull market geniuses, but they usually don't do well when the market turns south. So I'm curious what this next, couple of years looks like, but we don't have to plan that far. Let's just dissect the day and win the day. So, all right, man, have a great weekend. Let's talk later. Everybody, thanks for being here. Happy Monday. Have a good rest of the day.
Yep. Bye guys. Thanks, Chris.
Bye.
All right, ladies and gentlemen, I know it's dark, the dark side over here. Thanks for being here for the Gamma Report. We'll be back next Monday for the next session of the Gamma Report. So make sure you guys don't miss it. Thank you so much. If you guys need anything, let me know in the chat. But other than that, I'm going to close this room up in just a few minutes. So thanks so much for being here, guys. Take care.